What if I told you there are completely legal ways to pull money out of your corporation and pay zero tax on it? Not a loophole, not some gray area scheme, routes that are written right into Canadian tax law. Most business owners never use them for one simple reason. Nobody ever told them the room existed. Welcome back to the channel. I'm Hassan from Spectrum CPAs, and today I'm going to walk you through the tax-free buckets, the legitimate ways to take money out of your corporation with little or no tax. And stay to the end, because I'm also going to show you the one mistake that turns tax-free into a 60% penalty. Yes, 60%. Let's dive in. I call them tax-free buckets. There are 3 of them, and how much you can actually take depends entirely on your situation. But first, one quick thing so nobody gets confused. This is not the same as the tax-free dividend between 2 companies that I talk about in my holding company video. That's money moving from your operating company up to your holdco. This is money coming out to you personally. Different things entirely. Okay, the 3 buckets. Bucket number 1, and this is the most powerful one, and also the most misunderstood one, is the Capital Dividend Account, the CDA. Now stay with me here, because this is genuinely one of the most valuable tools in all of Canadian tax. And I bet most of you watching have never even heard of it. Don't worry, I'll make it simple. Here's how it works. When your corporation earns a capital gain, say it sells an investment or a property at a profit, only half of that gain is taxable. The other half, the non-taxable half, gets tracked in a special notional account called the Capital Dividend Account. And you can pay the balance out to yourself as a capital dividend. Completely, 100% tax-free. The same thing happens when your company receives a life insurance payout. A big chunk of that flows into the CDA too. But, and this is the catch, you only have CDA room if one of those things has actually happened. No capital gain, no insurance payout, no room. Bucket number 2, repaying a shareholder loan. If you personally lent money into your company, and a lot of owners do, especially at startup, the company can pay you back. And that repayment is tax-free because it's your money coming home, but it's capped at whatever loan balance is actually documented in the books, which, by the way, is one more reason to track those shareholder loans properly, like I always say. Bucket number 3, return of capital, or PUC, paid up capital. You can return the capital you originally invested to start the company, tax-free. I'll be honest with you though, for most small businesses, this one is tiny. When you incorporate, shares are usually issued at a nominal amount, like $100. So there's usually not much to return. It exists, but don't get your hopes up on this one. Now here's a word of caution. Mistake, I promise you. And it almost always happens with the CDA. Owners estimate their CDA balance instead of formally verifying it. And if you pay out a capital dividend that's bigger than your actual CDA balance, the corporation gets hit with a 60% penalty tax on the excess, plus interest, 60% on the overage. Now let me show you exactly how this happens with real numbers. An owner believes his CDA balance is $100,000, so he declares and pays out $100,000 as a capital dividend, feeling great about it. But when it's formally verified, the actual balance was only $80,000. That means $20,000 was paid out in excess, and that $20,000 triggers a $12,000 penalty plus interest, running from the day he took out the money. A $12,000 penalty on a move he thought was saving him tax. And here's the sneaky part that catches even careful people. A capital loss in the same year can shrink your CDA balance. So a capital dividend that looked perfectly fine in June can become an overpayment by December if your transactions aren't timed carefully. That's exactly why strategic timing matters. Planning your transactions to preserve your balance and get the optimal payout, and why you never just estimate this. So here's the discipline. And this is the depth most people never hear. Never estimate the CDA. Verify it formally before you pay a single dollar out. There's a specific election you can have to file with the CRA to pay a capital dividend, and the balance has to be confirmed as of that date. This is the textbook example of a situation where a 20-minute check with your accountant saves you a 5-figure penalty. Tax-free is absolutely real in Canada, but it is specific and it is limited to the room you actually have. Respect the room and it's a gift. Guess it and it's a 60% penalty. Now, CDA room usually gets created by things like selling an investment or a property at a gain inside your corporation, or from a life insurance payout. Selling your business is actually a completely different strategy with its own separate exemption that can shelter over $1 million of the gain from tax. I break that whole strategy down in this video right here. Watch that one next. But first, if you're wondering what's actually available to you tax-free right now, that is generally the right first question to ask. And it's exactly what my team at Spectrum CPAs checks for our clients. Book a free call. The link is in the description and will tell you what room you actually have. All right, your questions. This one's from Kevin, and everybody asks it. Hassan, how much can I actually take out tax-free? Okay, Kevin, here's the honest answer. It depends entirely on your situation. If you've had a capital gain or a life insurance payout, your CDA room could be $50,000, $100,000, or more. Your shareholder loan repayment is limited, whatever's actually on the books. So the real move, the first move for anyone, is to sit down with your accountant and ask one simple question. What's available to me tax-free right now? And the second one, this is from Layla. If I don't have any CDA room today, am I just out of luck? Not at all, Layla. And here's why. That's good news. It just means the room hasn't been created yet. As your company realizes capital gains over time, that room builds up. So this is something to plan for and watch, not a one-time thing you either have or you don't. So yes, you genuinely can take money out of your corporation tax-free if you have the room and if you verify it properly. Don't estimate it and don't leave it sitting there unused. If this opened your eyes, hit like, subscribe for more, and send this to a business owner who's overpaying just to take out their own money. I'm Hassan from Spectrum CPAs, and I'll see you on the next one.